So always a pleasure to come to Frankfurt. Thanks for the invitation, Richard. Thanks for hosting to Ashurst as well. So what I'll be talking about this morning is really the debt funding gap. But before we get there, I want to set the stage and give you an outlook of how we see the real estate markets in Europe at the moment. Because a few things have gone wrong, you might have noticed. So let's talk about it. It helps to talk about it. It's sort of therapeutic, right? So we can come to grips to what has happened. So the macro backdrop, if we just start with that, is on the right-hand side, I'm showing the inflation numbers. That is really what's been driving all of this story that we're in, the cycle that has turned. And that's because inflation peaked at 10 to 12%. We always like to compare the UK to the Eurozone because, well, it's sort of fun, right? They wanted to get out and now they are suffering from some of the consequences. So that's always fun to point out. You can see also the policy rates. Now, the policy rates is a topic that I talk about a lot. And of course, the ECB cut rates, when was it? A week and a half ago now. So that was a helpful signal. We talked a little bit earlier about this as well. But to be fair, the policy rates are, of course, targeting for inflation to come down to 2%. And it has already come down a lot, right? So that's why we have this rate cut now. Hopefully there'll be some more, but it's not really our job in real estate to forecast base rate cuts. We are really using the swap rates, and I'll come back to that in a minute. In the meantime, if you look on the left, you can see that the GDP growth numbers have recovered. So you see this massive rebound. Of course, you see also the COVID hit, right? So we just wanted to remind ourselves that it's not that long ago that we had that big hit, a massive revival. And now we are sort of coming back into a slow recovery. Last year, we still saw a technical recession, even here in Germany. I think we had 2 quarters of negative GDP growth. Again, we're talking about 0.2% negative growth, right? So it's very modest. It's certainly not a deep recession, but it was a technical recession nonetheless. We are coming out of that. You can see also we update every 6 months in March and September, and you can see that actually for the GDP numbers, there's not a real big change. So that's actually a good job on behalf of the central banks to keep that recovery in line. So the rate hikes that they have, it didn't really kill the economy completely. So good job, I would say. And then if we look at real estate, this is sort of what we like to look at. And so here the swap rates that I mentioned already, the dotted line, right? So good news, it's already stabilized a little bit. This is a little bit old data, so this is always the problem. Of course, things change all the time. We are not stock pickers. We don't need to update this every week, you know. But clearly the market moves and it prices in their view of not just the rate cut from a week or two ago, but also for future rate cuts as well. And you can see that swap rates stabilized, and that means that the all-in borrowing cost that we estimate based on some of our in-house data that we have at AW, you can see that the all-in borrowing costs are, well, just over 4%. And this is a European, actually this is the Eurozone average, because of course the UK is quite a lot higher. But that means that actually, if you look at the yield movements, yields have massively gone up because of where bond yields have gone. And that means that actually debt will become accretive again. During this period of time, when the all-in debt costs were higher than the property yields, most investors are not going to use that, right, if they can help it. So if there's enough capital, they wouldn't use it. On the left-hand side, I'm showing you the bond yields. Those are the ones on the bottom. And you can see a massive increase in those bond yields because they were at 0 for a nice long time. Great, wind in the sails, full blast going forward. But then we had, of course, the inflation triggered by the Ukraine war and all of that. And now our look forward, and this is forecast from Oxford Economics that we use. To be fair, a lot of other people use them as well. I think they're sort of a consensus forecast. You can see that bond yields are forecast to come down in line with inflation, right? So that all makes sense. You can see then also our forecast for property yields. So property yields already winding out. That's the black line. And now we are expecting them to top and to slowly come back down again. You can also see that this is not a one-for-one correlation, right? So you can see bond yields widen out a lot, property yields also widened out, but not by as much. So the excess spread obviously has reduced. So that's all in the background. In the meantime, the occupier markets have actually done quite well, perhaps with the exception of offices. So this is actually some new data from INREF. We are huge fans of the INREF asset level index, which is being starting for a while now. And we are mining that data. And the only data that we actually have on vacancy rates that are not from the brokers, because they are not very good at giving, for example, residential and retail vacancy rates. But INREF allows us to do that. You can see that for the COVID, you see a big increase in the residential vacancy rates. That has now settled down. People have moved back into their apartments. In the case of offices, people have moved back to their offices, but not to the same extent as they probably did before the COVID hit us. And that means that the vacancy rates are still going up. And in fact, they're a little bit higher in the INREF data than what we have from CBRE here on the right. Now, so the data on CBRE on the right is prime office markets across Europe, but the vacancy rate, of course, covers the entire market. If we look at the stats, it's maybe something useful to put in perspective the US. The US has a vacancy rate of nearly 20%, and that should make us feel pretty good, because our vacancy rate is only about 8% at the moment, and we expect it to come down. Because the big difference between the US and Europe is that new supply of buildings, I mean, maybe with the exception if you look out the window here, there are a few cranes around, right? We do need some new buildings, but on a relative basis, the supply of new buildings in Europe is much more modest than in the US. And that means that regardless of the impact of working from home, which we do expect it to be reducing the demand for offices, the vacancy rate, because the supply is much more modest in Europe, has a smaller impact. So the vacancy rates across Europe, there are quite big differences, even within cities, right? So we don't have data for suburban Frankfurt, for example, but we do have it for Paris and London. CBD vacancy rates are typically a lot lower, and some of the suburban markets, I mean, is Canary Wharf a suburban market? I guess it sort of is, but you see what my point is, right? So the CBDs have lower vacancy rates than some of the more peripheral markets. If we then look at our forecast for rental growth, so this is sort of combining some of the data for the GDP growth as well as the vacancy rates and the supply of new space. You can see that our forecast for rental growth is come down a little bit from September, but is still positive first of all, and you can see the different scenarios. I just want to note that the sensitivity to the macroeconomic scenario for retail is a lot bigger than for the other sectors. In the case of logistics, in fact, that has our highest rental growth, GDP growth doesn't really make a difference because the vacancy rates are already so low, they're 2 or 3%. It's not going to matter, right? But in the case of retail, if we have better economic growth, the rental growth will be a lot higher, okay? So if we then skip ahead and look at some of the investor perspectives, and this is where it becomes quite interesting. This is the capital values across Europe for offices versus the other sectors. So offices has, of course, been the least favored sector for many, many investors, and you can see why. Because it's taken a massive capital hit. The cumulative capital value decline for offices in Europe is 26% over this period of time. That's a massive decline. The other sectors, if we exclude offices, only have 16%. As you can see also from our forecast, we do expect a recovery. And in fact, we expect a stronger recovery for offices than for the other sectors. But that's only because it's come down so much as well, right? So this is the pain that is going through the system now. A lot of our clients are still, seeing the suffering in those capital values, the valuations. And that is, of course, then tying into some of the discussions that we'll have later on the debt side of things. And this is, well, actually, I'm probably going to skip over this, but just to highlight, this is the sentiment survey from IPE. And it shows here that the office sentiment is still very, very weak. And that's because all of these investors have been suffering losses in offices. I'm not going to cover the yields, but you can see in general that the yields are coming down. It's just different for different sectors. Maybe just one thing to highlight, the red line is the offices. See how massively up those yields have gone in Europe, right? So the biggest yield widening of any sector in Europe is in offices. And we do expect that to come down, and that's why, at the end of the day, our forecast for total returns in Europe is that office is actually showing the highest return. Now that is a very, very difficult conclusion. And that's the advantage of research. We can change our minds. If the data changes, we can change our mind. Our investors are not so lucky. Our fund managers are not so lucky. They already stuck with those offices. So I accept that this is a little bit difficult. And in fact, we have had a lot of questions from our CEO, our clients, everybody. But if you look at the math, if you start with new money today, and you cannot feel the pain from the last mistakes that you've made, if you have new money today, we think you should consider offices. So we think the negative sentiment is overdone. But of course, we're just research, right? So we understand that. But if you then look across the markets, UK coming out number one, mostly because their yields to begin with are higher, because their bond yields are higher, and that has a massive impact on total returns. Okay, now we get to the real fun, the debt funding gap. I think this is why I got invited today. And this is what we are doing here. And we've been doing this now for about a year and a half. Of course, I did it at DTZ in the previous cycle as well, just for full disclosure. So it's not something that's entirely new. But what we're doing is we're trying to estimate, with the debt funding gap, the total quantum of debt that is difficult to get refinanced. So this is the step-by-step analysis that we do. Now in this case, I've used the loans that are secured by German offices that were originated in 2019. Those we assume will be refinanced in 2024. Now we can talk about in the discussion, because I don't think all of those will get refinanced. There'll be some restructurings, et cetera, but the math is basically like this. You know, we have the purchasing volumes here, so it's about just over 25 billion of volumes. We know what the volumes are. We have all the data from RCA. So, and then you can assume that the LTV at acquisition was about 60%. Now we're playing around with that. There's some new data from Moody's that has come out that could be maybe a bit more precise. We also know what the capital value decline was, because it's already in the past. We're not predicting anything here. We know what the capital value decline was. So you come down by 7 billion for that vintage of acquisitions. That means that the new asset value for that sort of vintage of acquisitions is only 18. So now the number has disappeared, but effectively we're assuming a 55% LTV when the refinancing happens. Note that this is lower than the 60%, right? Initially, when we first started estimating, we used 50%. We got a lot of feedback from the market. Oh, it's not that bad, blah, blah, blah. Okay, you know, based on some new data, we have now put it at 55%. But that means that the new debt that's available to refinance all of those acquisitions is lower by about 5 billion. Okay, that's the debt funding gap. That is the amount of debt that is going to be very difficult to refinance. So if there's no questions on that, because that's really the sort of step-by-step, yeah.
It's more of a technical question. Will you actually be sharing the slides after the event?
Yes,
okay.
Richard will be
Yes.
able to share those. Yeah. And then, of course, what we do is, if you get your head around this step-by-step, we do it for 20 countries in Europe. We do it for 6 different sectors. You can see the sectors here. Richard, we do senior housing as well, so there's not that much there, to be fair. We do it also for the vintages of 2018, 19, 20, and 21. Those are all the vintages of loans that we think are going to mature in the next sort of 3 years. We will be doing an update. The update will, of course, go further into the future. The problem is that for the 2023 vintage, we already know that those did not get all refinanced. So the assumption that we made last time we did this was we basically said, okay, any loans that were scheduled to get refinanced in 2023, we said, okay, 50% did get refinanced. Okay, fine. The other 50 we spread into the future for 24 and 25. So we'll probably do something similar with the 2024 vintages or the 24 expiries or refinancings, because we know that they will not all get refinanced. But then I'm giving you the results here. The top line number is 99 billion. Okay, that's a nice even number, right? I'm not sure why we couldn't get to the 100, but you know, the point is you can see the different vintages coming through with the sectoral you know, exposures. Okay? You can also see that 2025 goes down. Why does it come down? Because it's COVID, right? 2020 was a very low year in volumes. So there's some logic to this, right? So, I mean, and of course it's all very mathematical here.
A question?
Yeah.
You assume some of the loans that are due in 2024 is going to be rolled over to 25?
Not in this analysis. In the next analysis, we will do that. In this case, we just basically said, okay, what cannot be refinanced? We basically, that's the debt funding gap that we calculate. So for 2024, we're not rolling anything over in these numbers, because we're just taking the 24 numbers. And then this is the country breakout, but this is on a relative basis. Now, why do we do this? Because 99 billion is a very big number, but big numbers are confusing. So if you have big numbers, you need to make it relative to the size of the lending market in each country. And that's what we're doing here. Unfortunately, Germany comes out pretty high. So you have the highest relative debt funding gap of any country in Europe that we could measure. UK, Italy, and Spain come out relatively positive. But of course, our analysis does not allow us to take into account country-specific assumptions. And I know from work that we've seen from Colliers, for example, which have done some really useful work on the debt funding gap on Germany, that their number for Germany is a lot lower because they have more precise data on loan maturities and things like that. Now, I would question some of their assumptions, of course I would, but like the point is that it does matter how much detail you have in the assumptions, particularly on loan maturities. So if your loan maturities are longer, clearly then you will have a problem that's further out into the future. You can also see that here the offices, the dark blue one is the sector that's probably causing most of the trouble, then followed quite closely by retail. But even apartments, right? This was a little bit of a surprise to see apartments in Germany and Nordics, because our impression was, okay, well, apartments are very safe, you have very granular cash flows, et cetera, et cetera. But the point is that the loans that were made in Germany at the peak of the cycle, super low yields on those assets, and also very low borrowing cost. LTVs maybe not so aggressive, but the change in the capital values is what's driving this, and the volume of the transactions. Then we did one step further, because the debt funding gap is sort of an artificial concept. So what we try to do is we try to boil it down to losses, because we don't really care if there's problems. I mean, it's great business for Ashurst, right? Because you can do a lot of work for the restructurings and help people sort out the problems. And I know there's a whole sector that's working on it. But for us, so here's the debt funding gap estimate that we had before. Then what we do is we do a few additional steps. So we basically say any loan that has a loan-to-value ratio over 75% actually does default. Okay? And then when it does default, we take another 25% off, because you will have delays in the enforcement procedures, and there will be cost, because lawyers don't work for free, and brokers don't work for free either. So if you need to sell the collateral, there'll be cost involved. Even taking into account all of those assumptions, our estimated loss for all of the European commercial real estate that we covered in the vintages that we calculated is about 2.4%. Okay. It's not nothing, right? 2.4% for loans that, loans are really not meant to have losses. But for these vintages, we are coming out, well, 2.5 actually. So 2.5% loss is what the actual CMBS numbers were showing post-GFC. We're coming out a little bit below that. So we feel good that we're at least in the same ballpark, using a very different set of data, of course. But so we'll be updating this. I mean, that's probably where I end, but the main point here is, perhaps to finish up with, is that banks have been reserving against these upcoming losses, and that's maybe where we should feel comfortable. Certainly the ECB and other regulators have said, okay, yes, we have a problem, but the reserves are strong enough to protect banks from major financial problems like the ones that we saw in the GFC period. So let me stop there and then hand over back to Richard for the panel discussion.
Good. Let's do some quick introductions. Let's start with you, Hans, because you didn't mention we know what you do, but you didn't mention anything about AEW. So quick introductions, and we'll work our way around. Just a little bit on yourself and AEW.
Yeah, so AEW is a global fund manager. We have businesses in both Asia, US, and Europe. Our European business has about 40 billion euros under AUM, mostly in France, so we're a French-owned company. We have a business also in Germany that's been growing actually probably the quickest of any of our European businesses. Offices here in town, I'll see our colleagues later. My role as researcher is basically to support all the fund managers and our clients, of course, as well, with data and strategy as they need to make their decisions.
Great. Matthias, over to you.
Yeah, thank you. I work for CAERUS Debt Investments in Düsseldorf. We're one of the pioneers in the German debt fund industries, founded 2012. We run now 7 debt funds. All in all, we have handed out over 2.6 billion euro in loans over these years, of which fortunately quite a lot has been repaid. So other than Chancellor Kohl said, die Gnade der späten Geburt, sometimes it's good to be quite early in the cycle. So now our loan portfolio is round about a bit south of €1 billion. We finance the entire spectrum from senior whole loan, junior, mezz development. Yes, we would do that, but currently we see no investor appetite for this type of financing, and we do that across the entire Eurozone, from Portugal, strong focus on DACH and Benelux region, Germany of course as well.
Great, thanks very much. Norbert.
Yeah, my name is Norbert Kellner. I'm with Berlin Hub, a German mortgage bank with a loan book of approximately 29 billion euros. Very active, of course, in the German market, our core market, but also active in some of the European neighbor states like France, Poland, and the Netherlands. Yeah, we are still active, even if we have to concentrate on some special things we will discuss later on, but happy to be here. Thank you.
Great, thanks. Fabienne.
Yes, I'm working for Loanboox. We are a fintech company which has built an own software for full life cycle management of financing. So from the bidding process to the monitoring until repayment. And on one side, we offer our software for our clients, and on the other side, we work as debt advisors using our own software and finding, good financing structures for our clients.
Great, thanks. Filip.
Filip Kurkowski, I'm a finance partner at Ashurst here in Frankfurt. We are a global law firm which, as one of its core industries, has real estate and finance. So being a partner in real estate finance is a good thing at Ashurst, or should be at least. Yeah, I mean, we've been involved in many financings for Pfandbrief banks like Berlin or others, and also for debt funds. Not for this debt fund, unfortunately, but we have seen a lot of different types of lenders in the market over the last years. So it would be interesting to compare, where they stand today.
Good. Let's pick up. I'm going to come to your presentation in a minute, Hans. But Norbert, maybe starting with you. I guess, how do you see the last? I think it's probably 12 months since we were here looking at this topic in Frankfurt. So just give me a view on the last, 6 to 12 months. Is it what we were expecting? What trends are you seeing? So I guess, how do you see the market over that period?
I mean, first of all, I was very relieved to hear that the figures we just heard are very much in line with our, let's say, personal view or impression of the market. And I would say, definitely a very interesting, to some extent, a challenging time over the past 12 months. Of course, everyone was expecting, let's say, a kind of distressed situation after all the things we just heard here from Hans. And the point is actually that overall, I would say that the impression how we could work out things or restructure things with our clients was overall rather positive. I think the discipline in the market, the discipline of the players in the market, completely different to times we, let's say, had to face a long time ago. And I think in that regard, the willingness, let's say, to really restructure things, we just heard about the financial gap, quite obvious. And when I look into, let's say, single transactions we had to discuss and to restructure, I mean, there was no need to convince people that we have to do things, right? It was more the questions how we can get together, how we can fill the gap in a particular transaction. And when we, let's say, have a look over the past 12 months, I would say there was almost always a kind of solution we could find out, a bit more equity here, a bit more amortization, maybe a bit more leverage to some extent on an existing loan. And that all brought kind of, let's say, a good move forward. So I would say, when I look at our, let's say, situation on the write-down basis, it's rather, you know, in a way that we can handle it. You just mentioned it. And I think looking forward, I'm rather optimistic that we can, let's say, you know, can fulfill future, let's say, topics and can find solutions as well. Having said that, my overall impression is that over the past 12 months, there was at the beginning maybe an impression that we can see a bit light at the end of the tunnel by the beginning of next year. Some very optimistic guys maybe said also by end of 2024. I think that changed really. I think we will go to a longer process, definitely during next year, very likely also maybe into 26. But again, we banks work on prolongations, we stick to the clients, we try to find solutions, and in that regard, again, it's a longer phase, but I'm still optimistic that we can go through that.
Okay, good. And just for clarity on that, Norbert, is that a solution that you've managed to work out with purely the bank financing and working it around, or is that also involved collaborating and bringing in other sources of capital, whether that's the debt funds or?
I mean, it's definitely something we should go into. My view is that when we're talking about institutional money, there are maybe some players really not that much more into this market for obvious reasons. We talked about mezzanine loan, or maybe we will talk about more about mezzanine loan, maybe in particular in the German market, too expensive maybe to some extent, yeah, because you can't really bring this in and find a solution when the liquidity is just not there. But I would say banks and maybe to some extent some new alternative lenders. Yeah.
Okay, good. It would be great to get everybody's perspective on that in terms of where we've been from your side, because the interesting thing here is we've got a number of different perspectives on the panel. So Fabienne, it'd be good to get your view. Where have we been? Where are we now?
So actually, we come from a time where we all made very good business, and in the last months, I would also say years now, we see a very restrictive market. I can see that the lenders increase their needs of collaterals, that they need harder conditions to give out financings. We can see that the acquisition market has decreased a lot. And we face huge problems in the project financing market. So projects out there are not very welcome to the classic lenders. They are a little, I would say, afraid out of much insolvencies and so on to give out a financing for a project. But we have a problem here because on the one side, we need more assets, we need residential assets, we need new buildings, and we need people to build it, and we need people to finance it. And if the financing side is giving out conditions which are not doable for project people, we have a problem because they are increasing the rent-up rates to percentages which are not possible to get out of the market. They step up the pre-selling rates to a point where they face the issue that it's not possible in reality. And that gets us to a point where a lot of projects are in the loop because they are ready. They can start building right away. I see that lately a lot, that everything is in place. They can start, but they don't get a lender. And then they search for new ways. And I see that the classic lenders are, of course, the favorite because they are not that expensive. But as it's not working these days, people get open-minded for alternative lenders, and they are willing to pay more costs because at the end, this will make the project come to real life, I would say. This is what I can see, and you have to take a little bit more creative parts these days. The institutes stuck to their local principles. A few years ago, they say, oh, that's a nice asset, that's a good deal, I take it, even if it's not my region. But today, they are all going behind their regional principle and say, no, we're not doing this, we do not have the expertise and so. And I can see that it's maybe better these days to build a consortium, that the banks have lower risks, and then the conditions for the clients are better. This is what I see now, and I don't think that it will be as 2029 or so, 2019, sorry, where we all make good business. I think it will take a lot more time until the market is healing, and I think it will take more months, and it will stay restrictive in the next months or years.
Okay, great, yeah.
Yeah, maybe just a couple of points. Well, first of all, this discipline that you're describing in the financing market, right? I think that's actually not such a bad idea, right? Because actually what is going to revive the market is if the vacancy rates remain low and people will work around the lack of debt financing, right? Or if it's too expensive, they'll have to use all of their equity. In the past, I think developers have gotten so used to having such a low cost of debt that we have become very unrealistic in the expectations, right? And I see, compared to the news that I see coming from Germany, where a lot of developers have actually gone into bankruptcy and seeing a lot of problems, in the UK, actually, we're not seeing that. And why is that? Because the banks have stayed away from lending to development funding. The slotting rules that the Bank of England put in place after the GFC took most of the banks out of the business of doing any development finance at all, which means that they had to either fund it from equity. Okay, this is when you put your own money at risk. I know it's a difficult concept for most developers to get their head around, right? But since they already bought their yacht in Monaco and they've already got their condo in Miami, perhaps the next one they should put some of their own money at risk, right? So I'm not so sympathetic to some of the borrowers that are in the market. And the discipline of having less supply, that will further help the market with rental growth, and it will make the projects more feasible in the future. So the rebound that you are thinking, okay, this will take a long time. I'm actually more optimistic on the rebound, because once the vacancy rate is hit such a low level, the rental growth will come. GDP growth is there. It's there to support the rental growth. So I'm a little bit less pessimistic on the occupier side.
I love a more optimistic view. That's good. Matthias, let's pick up your perspective.
Well, with regards to developments, we see very limited appetite of German institutional investors to engage in that type of financing. We see more appetite from the Anglo-Saxon investorship, targeting returns of 13, 14, 15%. And of course, that's then a bit of a challenge to bring the business plan of the development in line with the financing requirements. So we see a lot of talking, not a lot of doing with regards to collaboration. I think you mentioned it, Norbert. I think that's exactly the way forward. it's not only debt funds and banks working together in finding a way out of the current situation. How do we handle lower values? How do we handle lower LTVs? How do we handle the funding gap? The other point is that I assume that in the near future now competing debt funds will start working together in some type of syndication of loans. That might be the way forward, but for sure the debt fund industry needs a repricing of the loans. We're not going to finance or fund the gap on basis of historic values. So after a full repricing has taken place, then the markets will pick up again, for sure.
Okay, well, let's pick up a little bit on the restructuring side. Filip, you're obviously seeing what's happening there. So are you seeing more? I mean, Norbert mentioned there that actually some of these things are being gradually resolved in a satisfactory way, and so people are finding solutions to that and restructuring the debt and making it move forward. What are you seeing? What's coming across your desk?
Yeah, I mean, up until mid of last year, we haven't seen many things going really deeply into insolvency close or insolvency state. Since the last half of last year and this year, we see a lot of insolvencies. We see a lot of, in particular, project developments having huge trouble because of cost increases on the one side and an LTV problem on the other side, and so we've seen a lot of different types of restructuring situations or workouts, and not all of them were successful, if you want, but some of them were, and if you have I think the rule is the more complexity in the financing structure, the more layers of debt, the more debt funds there, with the more mezzanine debt, the more difficult will be the restructuring, and it's pretty clear that the lower levels of debt will get nothing. So we'll have a total loss, and in some situations also the senior lender has to take a hit. So there's a lot of these situations, including, like, if you look at Project First in Berlin, 1 billion development, 1 billion debt on this almost, and this has been restructured through an English restructuring plan, which was possible because of the size of the project and different participants who wanted to invest new money. However, in a lot of other developments, you don't have anybody who wants to put in additional equity or at a cost that nobody wants to pay. And so we still have a situation where debt funds and banks are trying to pretend or somehow, push the problem into next year. But slowly, I think we will see more and more of these situations where people have to write down their debt and equity, and that will definitely lead to a repricing.
So maybe just a question: Are you working? I mean, we've seen the PBB sale, right, where they sold a portfolio of some loans in the US and UK. They claim it was a performing loan portfolio, so it was an NPL, but they did sell it at a discount, and I'm always a little bit wary that when people sell at a discount, okay, and it's still fully performing, that sounds a little bit weird, right? But are you seeing any single loan sales or partial loan sales?
Not many yet.
Yeah,
but what we see is clearly people forming up to advise, to invest in NPLs. So that's, I think we are at the edge of some NPLs. I don't know if it's going to be a wave really.
But no client codes created on the system yet for the NPL deals.
No,
Okay.
no. But I think there definitely will be more of that in the coming months.
Okay.
And do you think that's partly? I mean, it'd be interesting to see whether. I mean, you mentioned, Norbert, as well, that the expectation in terms of the market, optimistic scenarios were later on this year, second half of this year, moving into 2025, and of course there was an expectation of probably higher interest rate reductions by this point. So do you think some of those deals, people were just thinking, well, the market's going to pick up, so we're going to be in a better position, and that reality is kind of kicking in, that it may take longer now? Do you think that's part of the issue?
I mean, you can see it, of course, when you look at the number of what we call bridge loans, right? Mm-hmm. There is definitely, since last year, a number of approaches from our clients to say, look, we don't want to fix things here for 5, 7, or 10 years even. We want to really bridge things for 1.5, 2 years, maybe 3 years. And that's their expectation, that there is a kind of, that the markets are back at that time. What I just wanted to add to the discussion beforehand, I think this is just an important point we have to have in our minds. Of course, this crisis is based, on these two big things. We had, after 12 years of a master positive cycle, this hit, and this hit was, again, in a combination of that the refinancing costs really went up dramatically from almost 0 to 1% to, what is it now, 3.5-ish, so it really, it tripled, so to say. And at the same time, with this kind of value decrease, and I think that was to some extent a bit underestimated. Underestimated in particular because it was really also not only a hit by a particular market or particular asset classes, it was really spread all over everything, right? Yeah. And I think this is the main reason why we just have to wait for a bit longer.
Well, so it's a good point that you mentioned also the coverage and the debt yields, coverage ratios and those sort of things. On our debt funding gap, we did test debt yields and ICR coverage ratios to see if it would limit the debt quantum on the refi. I didn't present that because the results were actually that those limitations or the terms that you already highlighted before, they are getting more strict now. We realize that. But when we run the math on the vintages that we have data on, actually it doesn't cause a debt quantum limitation on the ICR or the debt yield. So we tested it, but the LTV was the most constricting factor. But you're right, the cause of this crisis is very different from the last one. And also I do think that in the end we came into it with slightly lower LTVs to begin with anyway, because GFC we're probably at 70 or 80. Although LTV is also subject for opinion, right? So Moody's, I worked at Moody's before, some of my colleagues are still going on there, of course, but they published a report last week where they actually highlighted the fact that loan-to-value ratios, the way they like to measure it, were very high for the vintages that are going to be refinanced in 26 and 27. I think we've discussed it before. That could maybe be supportive of what you're saying. This could take a bit longer because maybe the loan-to-values that were underwritten versus the real ones might have been quite aggressive in that rebound year 21 and 22, which are still coming up, right?
Yes, absolutely. I wanted just to pick up a little bit on interest rates, what our view is now on that. Obviously, the ECB did drop. Bank of England probably will post-election. It looks relatively likely anyway. So is that a material difference? Is it more a signal to the market? Will it perhaps help move sentiment? What's our view on that and what's our expectations, and have they changed, I suppose, in terms of the interest rate cycle? I mean, Norbert, I don't know what your view is, but let's pick up everybody's.
I mean, we just talked about that at the beginning before we started here this session, that I think the expectation of lowering interest rates from the EZB, when we talked about that topic a year ago, was of course much more progressive. I mean, people thought about maybe 3 steps for sure this year. Now we are happy that we saw one, and maybe it is the only one. Maybe a little other one. We will see. So I think, I mean, this topic has been discussed a lot. Wherever we will end, it will not be the same situation like 3 years ago, right? So the financing cost will be substantially higher, whatever comes. And I think this is also something which has, of course, a huge impact of everyone who is investing into real estate. You mentioned it. We come from a long phase where financing costs were just almost nil, right? And now we really have to cope with much higher interest rates, and that is, of course, an impact. Again, we will see that for long.
So I think a lot of this is already priced in the swap market, right? But I think what is actually super interesting when we look at our data on margins, for example, loan margins, they have moved up a little bit, but not as much as you might expect. So if banks are pricing risk by using the margins, I mean, of course, there's other terms like the covenants and other terms in the loans, but if they're using the margin to price risk, we haven't seen a massive increase in the margins based on any data that I've seen. And so that's also perhaps supportive of that, that will become more accretive as the property yields have now widened out. Okay, it's still painful. A lot of people are still taking those valuation declines. But going forward, I'm actually quite optimistic. I always like to make fun of our forecasting team, which of course I'm responsible ultimately for those forecasts. We have this historical volatility that goes like this, and we're like here, we're coming out of it. And then there's the forecast that is sort of like flat. And I'm like, it's never going to be flat. It's going to be much higher or lower than you think it will be. And the models that we have are not very good at producing sort of rebounds. So my feeling is that based on just past experience and looking at the data of past cycles, we are still in the doldrums. We are dealing with all the problems that we created for ourselves, but the rebound will probably be much quicker and better than what we currently expect. So I just wanted to add that sort of positive spin on it, because we can sit here and talk about all the problems that we have, and there are many of them, and they might even get a little bit worse still to come. But the fundamentals are strong. There's no recession. Interest rates are higher than they were, but actually they're still below the long-term average, depending on how far back you go. So we are still in a quite a positive situation. The banks have reserved positively, and the ECB is on top of that. It'd be great to have a bit more transparency in the market, but that's sort of a separate point.
Yeah, good. Let's also talk a little bit about what is being financed, what there's appetite for, because although there's a limited market at the moment, it would be interesting to know from those who are lending, what is being lent, what are people happy to look at the moment. We've obviously established that there's an issue with some project financing. But maybe let's start with you, Matthias, on that, and then I'll come to you, Fabienne, as well.
Actually, we of course, to every rule, there's the exception. So we're actually seeing development finance where we're actively engaged in, which is fully repriced, and we are talking about returns which are appealing to Anglo-Saxon investors, with the business plan which is, I think, quite realistic if you look at exit yields. So we're not talking about something like for offices 27, 28 times annual rental income, but more of 20, 21, 22, quite realistic. If we talk about German capital, I think German capital acknowledges that now real estate debt is a superb asset class, but that real estate and everything related to real estate is now put into one box. You just need to read the press, media, who has lost money with, let's say, the recent bankruptcies. It's been all in the Bild. And I think trying to convince them to re-enter the lending market will be a bit of a challenge. So good luck there. So again, there I think it's going to be quite pro-cyclical, so that this type of investor will finance existing assets, secure cash flows, fitting to their low cost of capital, but not seeing the opportunities more Anglo-Saxon investors are seeing, grabbing, and trying to grab over the next couple of let's say quarters.
And in terms of sectors, Matthias, is that across, I mean, you mentioned that you were kind of all across all asset classes, but are some more in demand than others? I mean, interestingly, in Brussels yesterday, the senior living side was being quite successful in terms of financing. So financing also development. Which was interesting because that wasn't what I was expecting actually.
It's a bit still kind of flavor of the day or flavor of the quarter remains logistics. Flavor of the day remains resi. We like hotel. And but kind of there, as a debt fund manager, I have to say, we are kind of much more opportunistic driven. So it's the individual asset, the individual situation of the owner, the banks involved. It's less so that you have this type of academic asset liability driven model, which with your types of allocation, there's an opportunity, you look into it, you grab it, you secure it. And with that, there's only one thing we do not do, which is care facilities, which we regard as too complex.
Too operational, yeah.
No, well, just alone in Germany, you have 16 different jurisdictions to capture all these jurisdictions as one team. And then if you want to scale that to Europe, we say, thanks, but no thanks. We're not going to do that.
So you're talking about nursing homes, right? Or you're talking about senior housing as well?
Senior housing we would do, but real care facilities, where we say it's somebody else can do it, but not us.
Interesting point, data centers. Yeah, because at the ULI conference in Milan last week, probably I was asked by everybody about data centers. That's it, given that there's a limited number of data centers currently in Europe, but because of what's happening in the US in terms of data centers and the increase in the discussion around AI and the need for it, it was a topic on everybody. So it'd be interesting I mean, it's still a niche sector at the moment, but...
in all fairness, I think, yes, everybody's talking about data center being the new topic. I think so far the business is done by our colleagues which are able to provide debt at a different cost level than a debt fund, because clearly the opportunity of refinancing for Berlin HIP is much cheaper than what we can do.
I mean, just to get on this, I mean, data center, yeah, very interesting. Always love to talk about that. To be honest, you know, our mother company LBBW, they are going into this topic, but it is a niche. And again, I'm more than happy to hear the positive outlook for offices, because I like offices and I like to finance offices. I mean, in the typical German banking loan book, the percentage of office is at least 40%, likely 50% or more. How much data center you can do to have a bigger impact, you know, or maybe some, if there would be some negative outlook on the office side. So I think, I mean, senior housing, I always heard that before, some 15 years ago. It is always coming up in a crisis that you think, come on, there are some niche products. Again, happy to do so, but on a long track, I guess you have to really focus in real estate on these core asset classes. But the point I want to make and to add is, of course, when we talk about office, for example, office is not office, right? I mean, we are really talking about so many different, let's say, perspectives for offices, location-wise, the ability to bring in staff, to be a modern place of modern working, digitalization, etc. So I really think that there are very interesting things coming up in these sectors, and we are more than happy to finance that. On the other hand, of course, when you look at all those existing assets, for example, in real estate, who can't provide that and who will be likely stranded, it would be very, very difficult to get financing for that. I mean, we would like to come back to this ESG topic later on. I think this is really one other very, very core topic we have to have in mind, independently from the asset class. If we're looking at things who are really very green, very energy sufficient, etc., these assets have a good outlook. The second step, what we at least at Berlin Hip see, things who can be transformed into that, also a very interesting area you can lend and you can invest in. But of course, those who are not green and see no perspective to get green, that will be a big problem. We have some of them, right?
Well, it's interesting we come to this topic, right? Because data centers are probably the worst, ESG, from an ESG perspective, right? They use vast amounts of electricity and water. Electricity is not even available in some of these places, right? That they want to, especially closer to cities where the electricity grid is already fully maxed. But I always get a bit concerned when everybody's talking about a small niche sector. I'm thinking the price is already not right anymore. That's the concern that I have. But there's no data, right, on this sort of stuff. But coming back to the office point, I think it is actually really interesting to see the negative sentiment in offices is not only based on working from home, but also the fear that there's going to be a lot of obsolescence in offices. Now, we've done some work on this, and I think it's a super interesting topic that the sector in general is only starting to get to grips with, right? Because there's, especially with the embodied carbon, right? So we've been focusing a lot on operational carbon, but operational carbon is not the only carbon that's there, right? So we can build a brand new building like this one. I don't want to pick on this building particularly, and say it's a very green building because we're very efficient. But the fact that you might have demolished an old building that was there, which releasing all the embedded carbon there, and then building a new building that uses a lot of materials to be created, I think if we can focus more on not just operational carbon, but also on embedded carbon, and maybe reuse some of the buildings that we have, that would be probably a lot better for our sector. Certainly for the climate, it would be a lot better. Because reusing existing buildings will always be less carbon intensive.
Yeah, and that's coming through quite a lot in the sort of analysis that we're getting through in terms of the impact journal. So picking up around those things. Fabienne, it would be good to pick up on you. Just briefly on what is attracting, what's working in terms of loans, where you be able to match borrowers with lenders, what's happening in that sense, but also pick up a little bit on that ESG point as well.
Yeah, actually it goes hand in hand, right? So if it's a plain vanilla deal, like a cash cow, it's a good asset, you have a low LTV, you have high debt yield, you have a long vault, then everyone is taking it. Because even though if the lenders are more restrictive these days, they want to do new deals. They need to do new business as well. A lot of institutes still are out there saying, I want to grow my book. So if it's a good deal, a no-brainer, they all take it, whatever asset class it is. If it comes to more complicated deals, I can see that residential is always welcome, as well as logistic, as Matthias also said. And I can also see that hotels are kind of welcome. They show after COVID that they are very strong coming back from the crisis, that this is a strong asset, and they came back even stronger after COVID. So it was really a push for that class. I can also see that there's a slow coming back in retail parts, which I know. I have been working for a bank for 3 years. I loved office as well. And I know that this is an asset class we all love to do. But these days, it's very hard. So if the vault is too low, if you have too many free spaces, it is not welcome. And this is really what I can see in the market, that it is very deal specific, what is working and what is not working. And development is not working good. What is working is prolongations. I think a lot of prolongation these days and some acquisition, but it's very less in the market. And coming to the ESG topic, I think it's going hand in hand, because if you have ESG criteria, the asset is a good one. If you don't have it, you have to say, okay, can I manage it to ESG? Then it's a good object as well. But if I am not able to get ESG criteria in that asset, it's a stranded one. And if it's a brown building and we can't manage it to get green, there is no place to get this financing out in the market. And so you have to think, okay, am I putting in more equity, or did I just drop the asset? And I think that is a huge problem we face in the industry at all. We have buildings, we have regulation coming out even stronger these days in regards to ESG. And what are we doing with the buildings which are not capable to get green? What are we doing with it? No one is financing it, no one is buying it, no one wants it, to be honest. And do we have like dead buildings in the future standing around because they are no longer in what we need to see from regulation and from financing side? And I do think that the market is not only having troubles because of higher interest rates. It's much more, and ESG is a huge topic of it, because no one is really knowing what is coming, what do we have to do in the future, and where do I get the capital from? I mean, if you have a building which needs capex, a lot of capex to get it green, I have to get it out of my equity, because I do not see much lenders really saying, okay, you need money for that, I am lending it to you. It's not really working these days, and I think this is a topic we need to figure out in the future. Where's the capital coming from modernization, and who is lending it?
I have a feeling that's almost a whole conference.
I think it is,
Yes,
right?
yes.
But let's get some brief responses on that.
Well, so the perspective that I would bring is that actually in the UK and Netherlands there are already lenders that are specifically setting up green capex lending programs. So there is capital available, and the reason why that is coming around, I think, is that central banks are also waking up to this. Central banks are not completely in their ivory towers. They see the regulations, of course. So this is now becoming a compliance issue, right? And in fact, the tools that we use, and we've worked a lot with the CREM tool, the Carbon Risk Real Estate Monitor, which is widely adopted as the standard now. You can use that tool, and there's many different consultants out there now that offer quick and dirty tools where you put in the address of the building, you give the age, you can get an estimate of what the energy efficiency would roughly be. And that will give you a CapEx number as well. The CapEx is not as high as most people fear it is. Now, okay, there's always exceptions to the rule. We can all agree on that. But when we estimated this across all of the European markets, we came out with an estimate of about 20 basis points in total return you'd need to give up for meeting the Paris Accord pathways, which are in the CREM tool. That is not a deal killer for most deals. So I think there's a lot of misunderstandings in the market. Obviously, there are buildings that are completely undermanaged, that have been sitting around for 20 years, that are... But my point on that is like, if you're not a responsible owner of a building and you don't put the CapEx in when you need to put it in, guess what? You should be penalized with a building that's zero value. That's what a responsible owner should do. And if you haven't done that, then you are not meeting your fiduciary responsibility if you are a fund manager. Or as a bank, you probably want to make sure that your borrower is doing that, right? But I think the big breakthrough that I've seen over the last year or so is that central banks are on it. They want banks to report on it. They want banks to report on energy use as well as capex. And so banks will not have a choice. They will have to make the funding available. And of course it's an equity journey as well, right? So doesn't have to all come from the banks. But I think it's, again, when I quantify these things, I always look for the quantifying bad news. That's sort of my job, right? But actually it's not as bad as most people fear. And so I'm not sure if that's in line with what other people are seeing.
I can't agree more. I mean, the cramped path is defined. There's no way out. There's a clear goal and a clear timeline. And I just can confirm what you just said about the reporting needs we have already on the banking side are massive, and it's good. It's for a good thing, right?
Yeah.
And what I want to add again is it's not that I disagree with that. We see again some assets which we can't finance or which couldn't get financed. But again, one point, we talk also about the attractiveness of, for example, again, my beloved office space, right? So when you look at Frankfurt here, for example, you have some areas which are just so good as a location for an office. And if you have there an old, maybe not ESG conform office, believe in the market, there will be to some extent a price which someone has to pay for, but which is then in his calculation fine for get this refurbished. There are experts already who are concentrating on these things, and then of course there will be banks who are behind that and other lenders, and they will finance that. And again, this is really some kind of crazy statement, but we talk about immobilien, right? About real estate at a specific place, and I'm pretty sure that we will see a lot of that which we can't see by now. But in a near future, that we see things and they can be refurbished, they can be turned into green assets, and there will be a market for that. So again, there will be losers and winners, and the interesting thing will be to find the right ones, right?
And there's definitely also a sense that we're picking up from the planning side in both cities and national and regional governments to understand that if you've got an asset that no longer works. So if it's an office, but it's a regional office and nobody wants that any longer, then just insisting it remains an office is not going to serve anybody. And so therefore to be flexible and allow reuse of that rather than for it to be demolished. So I think that's an interesting point. I just wanted to come to one thing on you, Filip, if I can. A lot of the discussion that I had over recent meetings has been about just that yes, there is activity, but the time everything is taking is just so long. Is that something that you're also seeing in terms of financing deals, just that it's taking significantly longer?
I think that's right. Yeah, I think if we look, when we quote for legal advice, we usually have an assumption on timing in that quote, and even if we take an assumption which is already with a lot of headroom, most of the time it just takes months longer. So, but I'm not saying it takes a year to finance something, but it just does not take 2 months. It takes longer, and but the good thing is we are seeing new deals in the market. So it's so including office with strong tenants, for example, which are attractive. Green buildings, ESG is important. What we also see is that a lot of people don't really know what it means and how it should be reflected in the documents, and so there's still a lot of room for education, I think, in the market. So everybody talks about certain buzzwords, but if you ask people, what exactly should I write into the loan document? And people look at me, and so I write something into the loan document, which is recommended by the LMA or by somebody else. But I shouldn't be doing this. It should be somebody who really knows, about the technical implications, who should tell me what to write into the document.
It's interesting what you say, because I always like to ask our asset managers, because during the whole COVID situation, of course, we could not evict any tenants. And then they retrospectively negotiated free rent periods for the rent that they didn't pay us, right? I always thought that was a quite creative way of resolving that. But the point is I always ask them, like, okay, if you are forced to give a concession, like in the case of free rents retrospectively, did you actually ask for disclosure in the leases? For example, the big green clause in a lease is actually actual energy use reporting from the tenant. Most leases don't have that. So if you are looking for one clause in your lease that is a green clause, ask for the tenant to report their actual energy use. Because we have a lot of leases that don't have that, and the tenant has the right to basically refuse giving you that information. If it's not in the lease, you can't make them report it. And even tenants that have on their website that they have a net zero strategy and they're completely green and everything else, right? And I won't name any names, but like a big logistics provider, they might still say, actually, we're not going to give that to you because it's none of your business, and we're not obliged to give it to you under the lease. So, even though they say that they're very green, and that's an easy thing to do.
Yeah.
I mean, kilowatt hours per square meter per year. Okay,
Yeah.
there you go. Write that in the document, and then you will have, as a fund manager, I can now report it. As a bank, I can now report it.
Yeah.
To the regulators that I have. Otherwise, I'm stuck on the lease terms.
Well, this is actually what happens when we give so-called green loans. That this is a kind of necessity that the borrower agrees to give us all of that, right?
Yeah, but the borrower has no control, right? Like if I buy a building with existing leases in it that don't have these clauses, then I'm stuck, right? I can't make up the numbers. And if the tenant refused to, if I had a single tenant, I might be stuck on that. But I think a lot of tenants are doing the right thing, so I don't want to make it sound like the tenants are being difficult about it. But that would be one clause that would be very helpful, actually, I think.
Maybe one more topic on the reason why restructuring goes so long, or maybe a bit longer than expected. I think we still have seen over the past years many of these financings where you have certain parties in it, like. On the debt side, not only the senior lender, but the mezz lender. On the equity side, maybe also co-investors, not from here, but somewhere else, maybe far away, when I look to Asia or into Asian areas. And that is also sometimes, of course, painful, right? Because you can't really make quick decisions. You really have to ask for and to wait and to bring this together. I mean, I'm a syndication guy. I shouldn't talk about that too loud when I bring in other investors, but it's a matter of fact that in such a situation at the moment when it is about restructuring, it's much more difficult when you talk about between 2-3 people or many more.
So question on that, like if you're the lead bank, you have a syndicate behind you, don't you have control as lead bank, as agent bank?
Yes, of course, but all of these negotiations, of course, take longer because, even if you put down, in between 10 days you need a reaction, there are some counter questions, there are some kind of not the answer you can get because they have to, of course, in the background to negotiate or to talk about with other co-investors, and that makes it just difficult and longer. It takes more time, right?
Well, but has anybody got a question? You are included in that. You have, yes. Go on.
I have a question. Hans, actually, I really liked your piece of research, specifically the funding gap. I presume it's a lot based on office buildings, right? But you mentioned for Germany specifically, like the residential sector, that you find some red flags. Could you go a little bit more into details what you found there?
Sure. Well, so first of all, we do it for all 6 sectors that I highlighted in the chart, right? So, and we have the same.
Co-producing also development.
No, so just to be clear, this excludes development activity, which is probably, convenient for the German market, perhaps, because it will maybe increase the numbers. But so our analysis is based on acquisition volumes that are produced by RCA. We take out certain types of deals, so we take out deals that are 100% equity. Okay, back in the days there were not that many. Now there are probably a lot more. But we also take out development activity as well, because that's also not really recorded that precisely in the RCA data. because a developer might buy a piece of land and then start building, but unless they sold the building, in which case it's not actually development activity anymore. So we also have a loan-to-value ratio that's uniform across the sectors. Now we know from talking to people that that might not have been the case, but the lack of better data is really forcing us to make those types of assumptions. And that's why I mentioned the Collier's report. We really like what they've done there, because they have more in-depth data on the German market, and they've mobilized that to do a German-specific analysis. You know, and that's where we are trying to cover all of Europe, trying to put it in a European perspective on a relative basis. So you have to make some sort of more bigger picture assumptions. That's where we are coming from. So to answer the question on the apartments are basically driven by a couple of very large deals at the peak of the cycle in the German apartment market. You know which ones they are, Deutsche Wohnen and all those guys. Those transaction volumes were there. Do we look specifically at an individual deal and look at, okay, how did they finance that? We don't have the time to really do that. Others might have done that. And of course, with some of the listed companies, they do issue bonds as well. We started looking at that actually with some EPRA data. But as far as the total amount of debt that's financed by bonds that are typically longer term instruments, you know, those are relatively small in the German context. So that explains the apartment numbers. Yeah.
Great. Any others? I'm going to count in my head down to 5 seconds, and 5 seconds have gone. Excellent, very good. Because I'm already slightly delayed. We started slightly delayed, so we finished on time, but later because we started later, which was entirely my fault, and apologies for that. Good. There will be time. Everybody, the speakers are all here. Teas and coffees are served again. So please feel free to ask questions you didn't get a chance to. And that all is left to say is thank you, and join us for a coffee. And join me in thanking both Ashurst again for supporting this and everybody else. Thank you.